right, so picture this. You've been following an expert's advice on a stock for 2 solid years, and it's been an absolute home run. Now, what if that same expert suddenly slams on the brakes? Well, that's exactly what's happening with SoFi. An analyst who has been championing this stock all the way up has just put out a major warning. So let's dig in and figure out what's really going on here.
To really get why this downgrade is such a big deal, you have to understand the history. This wasn't some random call. It's a major reversal after a long, and I mean long, winning streak.
And this timeline, it pretty much tells the whole story. For almost 2 years, the call was simple: buy. And you know what? It worked. Investors who listened saw the stock nearly triple in value. But then, this past October, boom, everything changed. The rating got slashed to a hold.
So this is the million-dollar question, right? After such an amazing run, why get cautious all of a sudden? What changed? Let's unpack the analyst's thinking piece by piece.
And just to be crystal clear on where we are right now, since that downgrade, the stock has already dropped about 10%. But even at this lower price, the verdict is still hold. The analyst isn't looking at this dip and thinking it's a buying opportunity. Not yet anyway.
Okay, so the first big piece of this puzzle is something SoFi itself did. The company decided to sell a massive amount of new stock. And, the timing of that sale, well, it's incredibly revealing. That's how much SoFi raised, a cool $1.5 billion. They did it by putting 54 million new shares out on the market. Now, this was not a small move. This was a huge capital raise, and it definitely got everyone's attention. So why would they do this? Well, it's actually a classic move by a smart management team. Like the quote says, when they look at their own stock and think, you know what, the price is getting a little stretched here, they seize that opportunity to sell shares and fill up the company's bank account. And this creates a real dilemma for investors, doesn't it? In the short term, you've got all these new shares flooding the market, which can really weigh on the stock price. But on the other hand, in the long term, all that extra cash makes the company stronger, making its future growth prospects that much more solid. So here's the bottom line on this. While it's a really smart strategic move for the long-term health of the company, it's also a powerful signal. It's coming from the people who know the business better than anyone else. They basically thought their stock was overvalued, and they decided to cash in on that high price. All right, now let's zoom out a bit from what SoFi is doing internally. The analyst is also seeing some pretty ominous clouds gathering in the broader economy, and that's a big part of the story.
This chart, this reveals a key vulnerability. See that huge purple slice? That's personal loans. They make up more than half of SoFi's entire portfolio. And the thing about personal loans is, they're the riskiest type. They're usually the first ones people stop paying when times get tough.
And the signs that times are getting tougher are starting to pile up. We're seeing job growth slow down, layoffs are starting to tick up, people are clearly tightening their belts. Look at restaurant spending, down 4% from last year. Even the holiday season was weak, not in dollars, but in the actual number of things people bought. So this slowdown creates the obvious risk, right, that people might default on their loans. But there is actually another, more hidden danger here that's tied directly to SoFi's business model. It's not just about who they lend money to, but what they do with those loans afterward. Here's how the chain reaction works. See, SoFi makes a lot of its money by creating these loans and then selling them off to other bigger lenders. But when the economy slows down, those other lenders get nervous. Their appetite to buy loans, especially riskier personal loans, can just completely evaporate. And this isn't theoretical. We saw this exact same thing happen in late 2022. It could easily happen again. So let's recap. You've got a signal of overvaluation coming from inside the company, and you've got these external economic risks piling up. It's really the beginning of a perfect storm. So now let's look at the hard numbers and see just how the stock price stacks up.
Okay, so based on the analyst's detailed model, the real intrinsic value of one share of SoFi stock is right around $18. Just remember that number, 18.
Now compare that to where it's actually trading today, around $27. That is a huge disconnect between the analyst's calculated value and the market price. And it's not just that one number. If you look at another valuation metric, the forward PE ratio, it tells a pretty similar story. Now, yeah, it has come down from a crazy high 60 back in October to 48 today, but a PE of 48 is still a very pricey multiple for this stock. So, the bottom line, when you just look at the pure numbers, is pretty clear. Even after that 10% price drop, the stock still looks considerably, and I mean considerably, overvalued. So, given all of these headwinds, the valuation, that big signal from the share sale, and the weakening economy, what on earth could change this cautious hold rating and turn things positive again? Well, the big hope really hinges on one thing: action from the central bank. The path forward, for better or worse, seems to depend on whether they're going to cut interest rates soon enough to stop a deeper economic slowdown. And why do rate cuts matter so much? Well, it's all about the consumer. Lower rates mean cheaper monthly payments on big things like cars and houses, which encourages people to go out and spend. That stimulates the whole economy. And here's the key part for SoFi: it would boost the confidence of those other lenders that SoFi needs to buy its loans. But that's just a hope, right? It's not a reality yet. So for now, when you weigh all the current risks against the potential rewards, the analyst is sticking to that hold rating. From this perspective, there's just more that could go wrong than could go right in the immediate future. So we're left with this crucial question. SoFi, the company, seems to be executing its plan really well, but it's battling a tough economic environment. So what's the one signal from the economy or maybe from the central bank that could finally flip the switch and turn this hold back into a resounding buy?